Hey, it's Lewis here and welcome back to the channel, and in today's video we're going to be analysing Intuit stock. We'll be using TIKR terminal to go through the financials, and then I'll put the numbers into my DCF and we'll come to a fair value of their stock. Let's get straight into it. So who are Intuit? So Intuit is an American business software company that specialises in financial software. The company is headquartered in Mountain View, California. This company produces all sorts of different accounting products, including TurboTax, personal finance app Mint, and probably most famous for QuickBooks. And they also got the product Credit Karma, and they also bought MailChimp as well. As of 2019, more than 95% of its revenue and earnings came from the US. So the company itself is listed on the NASDAQ, and it's a component of the S&P 500 index. Now let's look at the sales for Intuit, and we'll start with the sales per business. So small business and self-employed in 2021 made up 49%, so about half the sales. Consumer made up 37%, Credit Karma 9%, and ProConnect 5%. Sales per region, it's showing up here that all the sales are in the US. We're just seeing that's not the case, so that might be an error. Because obviously if you've got sales in the UK, QuickBooks is quite a big platform here, but it's saying all in the US. So not much help there into the sales per region. Now let's have a look at the financials for Intuit, and we'll go to TIKR terminal to do this. So we'll start with the income statement, and over the past 5 years, they have nearly doubled their revenue, so that is lovely stuff. Gross profit margin looking very solid as well at 84% here. That's a lot. That is a lot. Net income to the company, so that's doubled as well in the past 5 years. Awesome stuff. Let's have a look at the shares outstanding. Increased ever so slightly, so maybe not too much of a big deal if they've grown as well as they have. Probably in play stock options most likely, but it hasn't changed that much, so we can't punish them too much with that. Total cash has gone up a lot. Love it. Now let's have a look at the long-term debt, and that's increased by a decent amount, but maybe with the growth we've had, that's acceptable. We'll come to see what the debt is like in a bit. Retained earnings as well has gone up a lot, which we love to see. Cash flow statement, so cash from operations minus capex is free cash flow, the most important figure when evaluating a company in my view, and this has gone up massively. It's doubled, it's more than doubled, so that's fantastic over the past 5 years. And you can see last 12 months it's ever increasing as well, so that is epic stuff. If that gets to 400-500, that's tripled in 5-6 years, so that's class. Capex as well is very small, so it just means they don't really have to invest much into their product because they've already done all the legwork. Very good signs. Issuance they're not buying back shares yet, and I probably don't want them to, because we'll come to see what I think the value of the company is. But you can see here they have been repurchasing stock and they've been issuing it as well. So, I'm not sure why they're buying back shares when the company's overvalued, but who knows. They're paying dividends as well, which is good. So we are giving some cash back to the shareholders in some way. Ratios, so return on capital is extremely high for this business. Past few years have tailed off a bit, but it's still at an acceptable level. Very profitable business here, as you can see. Lots of cash flow as well, which is just awesome. Very high current ratio. Debt to capital, it's a bit all over the place here, isn't it? Goes up and down, up and down. Something to keep an eye on. 19% here, 29% here. 30%. So something to keep an eye on there with that debt to capital. Something going on with the capital structure. Just have a look at it, see what debt they've got, see if they can pay it off with free cash flow. Simple as that. But if you like to look at TIKR terminal, I've got a link in the description below. Please use it and sign up. If you enjoy this platform, let me know. I'm really enjoying using TIKR. I think it's a fantastic bit of kit for about a tenner a month. Can't go wrong if you're into analysing your own companies. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions, you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you there. Now let's have a look at the genuine impact stats for Intuit, and we'll start with the quality metric, and it's looking very good here, so very high. It's got the shield around it, so it means it's one of the highest quality stocks on the platform. And yeah, so profitability very high, financial strength strong, capital allocation very sound, so it's looking good on all the metrics. But it comes to valuation, it's looking very expensive unfortunately on all metrics. What can I say? It's got a forward PE of 55. Yeah, questionable, let's be honest, with the growth I've got. But yeah, we'll get to that in a bit. Historical growth is looking high across the board, as we've just seen, that's no surprise. But yeah, some interesting insights there from Genuine Impact. Now let's take a look at the analysis checklist for Intuit, and we'll start with some basic metrics here. So market cap is 118 billion, P ratio of 47 and earnings yield of 2%. So instantly we're thinking overvalued, you've just got a P of 47. There's not many companies with P 47 I would buy. But there might be a reason why the market is pricing them so high. Look at these stats here. So return on capital 43% 5-year average. So one of the best out there, let's just say that. Profitability wise, very profitable business. Software is often very profitable. Probably my favourite business model, to be totally honest. Makes the most money, simple as that. Free cash flow is also higher than profit. Love it. Current ratio is 2. Brilliant. Cash conversion cycle, very, very good here. So it's a negative number, which basically means the suppliers of Intuit are cash financing their business because of the payment terms involved. Because it's a subscription software business, they must get their monthly income straight away, and whoever they're paying for their suppliers, for whatever the inventory being a software business, they take a while to pay them, so hence a negative cash conversion cycle. Total debt to capital 90%, not much debt at all in the business. Profitability to grow, as we've seen, obvious, all green. But then capital allocation wise, they've issued some debt, but with the debt to capital being so low, it doesn't matter really. Decrease in share count, increased ever so slightly, not a big deal. Dividend growth, we have increased for dividend, and this one's a bit negligible, so all of these are a bit harsh, but it's my rankings, it is what it is. So 80% quality score, buy at a fair price, P ratio of 47, price of free cash flow 37. So looking expensive, and this is what it looks like. So $236 per share for me to be interested in this company, and I want to buy below that. So it needs to drop another 43%. Even with the craziness of the market in a minute, it still needs to drop 43%, and I won't be touching it. We'll have a look at DCF now, and well, we'll just look at the stock price over the past 6 months. It was $600 and it's dropped 36%. Just shows how overvalued some of these companies are. It still needs to drop 40. Oh, did not mean to do that. What am I doing? Yeah, so this dropped 43%. So simple as that. It's overvalued. There's not much to say other than that. Share price of $236. Free cash flow from marketscreen.com. You know, quite generous as well. How much I think the free cash flow is going to go up. From 4 years, from 2020 to 24, I think it's going to double. I think that's generous, let's be fair. So $236, just overvalued, simple as that. High quality business. Not much to say other than overvalued. Wait for it to hit the price, and we'll see. So there we have it. That was my full stock analysis for Intuit. If you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time.
Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.